You are listening to Keystone's Stock Talk Show, episode 305. This week, I will kick off our Your Stock, Our Take segment, answering a viewer question on 5N Plus, VNP on the TSX, a global producer of specialty semiconductor and performance materials powered by record quarterly profitability. Stock is up 50% in the past month. We revisit the company and let you know what is driving the growth. Second, Brett takes a look at Cipher Pharmaceuticals, symbol CPH on the TSX, a small cap Canadian pharma company that clients should be very familiar with. Keystone recommended the company at $3.89 back in August of 2023, just under 2 years ago. And today it trades above $15, up nearly 300%. After a very strong quarter, Brett lets you know where this small cap is today. Brennan takes a view or question on Honest Company, the Honest Company, symbol HNST on the NASDAQ, Jessica Alba's personal care company dedicated to creating clean and sustainable design products. Brennan takes his third look at the business. We're not sure why, but I think we do. Now, lets you know if Alba shines as brightly in the markets as she does on screen. Finally, Aaron gives his take on one of the giants, the Mega Cap 7, Amazon, on its Q2 numbers. All right, let's get to the show. We welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
Doing well.
Wow. How are you?
I am good. I'm good. I'm very good. Yeah, I'm just hanging in there. We're good. So did we have a lot of things we wanted to talk about, or do you just want to get right to the poll question this week?
I think we can get right to the poll question, and then I ended up writing up just some commentary for our recent newsletter that went out to our email list. So I would maybe like to just make some comments on that after we do the poll.
Sure, let's get to the poll. U.S. June jobs report, I believe. That's where we're starting.
Yeah, the U.S. June job report, it came in well below expectations. It only added 73,000 jobs. And as well, at the same time, May and June were revised down to 19,000 jobs added and 14,000 respectively. And this really is just, once again, stoked recession fears on top of further tariff announcements happening over the last couple of weeks as well. So the question is the U.S. heading towards a recession? 78% of our viewers say the U.S. is heading towards a recession, and 22% said the U.S. economy is resilient and won't go into a recession. And I've been listening to a lot of macro podcasts recently, and it seems to be a very mixed bag. There doesn't seem to be that clear consensus like you do at some points in the market. You have some very bullish takes still, and others where the U.S. economy is falling apart. So it's a very mixed bag, and I think you're seeing that reflecting more and more, because there's not one true good signal ever for the market, but you have a very mixed bag right now, I guess is the best way to put it.
Yeah, I agree. And that's the thing is according to the CME FedWatch tool, the market now sees a 90.4% probability of the Fed cutting the interest rate by 25 basis points in their September meeting. That's up from 63% a week ago or 64% last month. So we still see the Fed having, the ability. They still have, the interest rate cuts in their back pocket in case if we do continue to see a slowdown. One thing that I found kind of interesting was looking at the economic data in Canada, looking at the import and export data. And if you look at the imports, for example, imports in Canada were up 1.4% in June, which is the first increase in 4 months. But the gain was in large part the result of an increase in imports of industrial machinery, equipment, and parts by 28%. So if we exclude, that one division there, excluding that product section, total imports were actually down about 1.9%. So, as we were, Ryan and myself were speaking about it just briefly is, are we still seeing a lot of, front loading, trying to get ahead of the tariffs beforehand, possibly. But as well, we've been tearing through the financials of every company that in the US and Canada that reports. every single day. And, that is one area or pocket of strength that I've been seeing for sure is, a lot of these industrial companies are continuing to pump out some good results. Will that continue? Who knows? But yeah, that's definitely what I've been seeing going through the financial statements.
Yeah, I mean, we just recommended in our U.S. growth and small cap research an industrial-based company that owns around 13, 14 U.S.-based manufacturers, and this segment seems to be on vogue. I mean, they did have tremendous numbers that just came out, but the stock in the last month is up nearly 50%. That's 50% in 1 month. You are seeing a lot of people pile in to those names, but it's driven by some underlying growth. If you miss numbers, you get punished in this market. If you hit, you really seem to get, or exceed, you really seem to get rewarded. It's a market of extremes. You're seeing you've got to hit those numbers right now or exceed, and have an outlook going forward. All right. Well, we can, we might as well. Brandon, you had some comments, right? Did you
No,
wanted to get to?
That was
it?
basically it. I think, as well, like I'm pulling this, out of thin air right now, but just off the top of my head, I thought I saw a headline. So, take this with a grain of salt, but I believe that it was something around like 82% of S&P 500 companies were surprising on earnings to the upside. So they were positive. A lot of earnings have been positive coming out.
I read something along those lines.
Did you see that as well?
I think that sounds pretty accurate. Now, one of the things to consider, though, is that the expectations were actually relatively low. So it's always relative to the expectation, right? Companies can do that too with their guidance, right? They'll be a little conservative on guidance, and then they'll be able to upgrade it and exceed it. But yeah, no, that sounds about right. So, I mean, there's good things about the economy, largely driven by, say, AI technology, a lot of opportunities to make industries more efficient, to generate economic growth. Like a lot of the growth in the industrial space as well has been driven by like data centers, the electricity demand, like those types of things. But it's difficult to know how an economy thrives when businesses can't make long-term decisions going out, say, more than a couple of years, right? Like AI is great in terms of making companies more efficient, potentially, maybe opening up some new markets. But at the same time, it's not going to build your factory or move it from one part of the world to another and then move it back at the whim of a policy change, right? So I would think as long as the uncertainty with respect to that persists, we're probably heading in the direction. But at the same time, there's so many factors to consider in the near term. You certainly don't want to invest under the premise that we're going into a recession, because there are good opportunities to be had.
And on the expectations front, I think Aaron was touching on this. Like it does sound extremely positive to have 82%, the company's beating expectations. But to give you an idea, you could have a company have the expectation for a 50% decline in earnings in a quarter, and they had a 49% decline in earnings, and that is going to clock in as beating expectations. It doesn't mean things are absolutely rosy out there. It's just they can be beating expectations, which were very low, right? So
can I say one more thing about just the economy and recession before we move on? I seem to remember in my Economics 101 class, you guys can probably remember as well, didn't they say it's about a 6-month lag before things really trickle through to the economy and you begin to see things actually manifest in like the macro headline numbers?
Yeah, it'd probably be on average. I mean, there's some things that would happen faster, some that would even take longer, right? I mean, you are not going to see the full impacts of this like right away. We're not even seeing those in the last quarter for sure. Yeah. I mean, and there's some, you might be, like we've said, like we have heard, now we interviewed a company on Friday, say they're not saying a pull forward of orders, but then they saw a pull forward in the first quarter. So you are seeing some businesses, I'm sure, getting a better quarter than they expected there, because there is some inventory being stocked, because in a certain environment, when you know you need to deliver on some contracts, you're going to hold more inventory. And at some point that inventory has to normalize. And when it does, like whoever you're buying for has a pause in terms of their numbers. So I think there could have been some weird pull forwards. Now we'll see. I mean, the industrial company that we talked about on Friday, said that they're busy. So, and they're busier than expected right now, and they're not really sure what to chalk it up to, but they're taking orders. There's some companies that we see that are busy that are taking lower margins. So, is that part of it? Do you see sales increases and worse margins? Potentially right now, right? You have to source from more expensive, or, they're facing tariffs, obviously. Like that company had some tariff issues too as well. So anyways, it's an interesting time in the markets. All right, I might as well get right to my segment. So I reviewed 5N Plus earlier in the year when the stock was up 62% year to date. It is now up 90% year to date, about 53% of that, an increase of about 53% coming in the last month. We're fielding more questions on the company, so I thought I would revisit. 5N Plus, symbols VNP, trades are just over $15, $1.34 billion market cap. A global producer of specialty semiconductor and performance materials, focused on developing, manufacturing advanced materials that are essential components for a wide range of products in critical industries. Here's a kind of a breakdown of their industries. In specialty semiconductors, 5N Plus produces ultra-high purity metals and compounds, often with 5 nines, so 99.999% purity. So that's the 5N in their name. These materials are crucial or critical for applications in terrestrial renewable energy. They're a major supplier of materials like cadmium telluride for thin film solar modules, which convert sunlight into electricity. They're used in space solar power. They develop and manufacture multi-junction solar cells for satellites and spacecrafts that power critical space missions. Also imaging and sensing. Their materials are used for radiation detectors, for medical imaging, X-rays, gamma rays, security and defense applications as well. Their performance materials, this segment focuses on materials that enhance the performance of various products. Health and pharmaceuticals, it's used in antibiotic creams, human care products, in technical markets, things like low melting point alloys used in aviation and other industries. So that gives you a broad background on 5N Plus and why the name 5N Plus. Well, let's look at the performance of this stock over the past year, up just over 90%. Great gains in the past month alone, up almost 53%. So what's driving the share gains? Well, a couple of announcements that have been made over the past 10 days. The first one we'll look at, they signed a scaled up and expanding critical materials supply agreement with First Solar, and I'll delve into that shortly. But secondly here, and is in most often the case, companies are driven by their numbers, their underlying financials, strong Q2 numbers, and they increase their annual guidance, and the market likes that, further growth than expected going forward. Let's look at a snapshot of those numbers. Revenues for Q2, up 28% to $95.3 million. The increase is primarily attributable to higher sales in the terrestrial, renewable energy, and space and solar sectors. So let's look at adjusted EBITDA. It was up 79%, so better margins there. $24.1 million compared to $13.5 million, driven by higher volumes of terrestrial renewable energy and space solar power sectors, and better prices over inflation for both solar power and their bismuth-based products. Adjusted gross margin as a percentage of sales came in at 34.6%, considerably up from 31.3% in Q2 2024, impacted by the same factors that I talked about. Net earnings, 17 cents per share, up from 5 cents in the same period last year. So strong growth in that quarter. Let's look at that First Solar deal. They got new volume commitments under contract. That increased by 33%. That would be from 2025 to 2026. Also volumes in the following periods up 25% from 2027 to 2028. The commentary suggests that almost all the supply is going to the U.S. market under relatively favorable pricing and margins. CapEx to expand capacity would be minimal here. They're taking on these new orders, but they don't have to add a ton of CapEx. It's the same footprint in their Montreal facility with additional reactors added. 5N Plus they also entrenched their relationship with First Solar by supplying them cadmium selenide. Now, in simple terms, it is an additive layer to new thin film solar cells that provides efficiency and performance. This is, however, not a large or needle-moving part of the agreement. It just kind of entrenches them a little more with a key customer. Let's look at their outlook and guidance. Through the second half of 2024, 5N Plus anticipates demand under specialty semiconductors from the terrestrial renewable energy and space solar power markets to accelerate as customers look to secure advanced materials from trusted and reliable partners. Under performance materials consistent with historical trends, they see volumes through the second half of 2025 are expected to be slightly lower in that area than compared to the first half of 2025, with margins continuing to benefit from the company's strategic global footprint and sourcing capabilities in the current environment. Now, based on its financial performance year to date, coupled with anticipated demand under specialty chemicals and better than anticipated performance in the performance materials section, adjusted EBITDA for 2025 has been revised upward to a range of 55 to 60 million. Last updated, or from the range of 55 to 60 million, that was updated in February of this year, to a range now of 65 to 70 million. So a significant increase. Now, looking ahead, the company stated it will continue to remain prudent in an evolving geopolitical environment, including with regards to the impact on operating costs. Management stated 5N Plus is well positioned to continue to solidify its leadership in key end markets through the end of 2025 and into 2026. That is why they upped their guidance. You can see here valuations. This is EV to EBITDA. 2025 expected about 13.1. Price to an adjusted EPS figure about 24.4 times. Looking into 2026, 11.3 times EV to EBITDA, and price to adjusted EBITDA is 21.8 times. So conclusion here, 5N Plus is a critical Western supplier of specialty semiconductor and performance materials for the solar, extraterrestrial energy, and medical imaging markets. Its products are essential to each vertical, and it appears from customer behavior around recent contract extensions and incremental spot demand, they may have a solid moat in the North American market. Trailing valuations are on the higher end, but it is, if growth is going to compound at 25%, the stock could be attractive. We expect quarterly lumpiness. The last quarter was very strong. Monitor, again, strong Q2 numbers, strong outlook, and we continue to monitor the business.
With some of these companies that are in industries that I would say or segments of industries that are somewhat cyclical, where you expect to see some volatility and lumpiness, but where it's an industry that whereby the long-term growth of the industry is fairly visible, right? Some type of an essential industry like semiconductors or essential metals. I don't mind the cyclicality in that situation, but you really then have to look at valuation. I mean, if you're gonna enter into a company where you're expecting some lumpiness, you don't want to have to do that whereby you're paying a premium, in my opinion.
Yeah. You always have to watch the cyclicality of these businesses. I do think that, as a kind of more trusted North American supplier, a lot of their customers are being driven more towards this company than maybe looking internationally right now. How long that lasts, whether it continues over the long term, maybe depends on the city government in the U.S. And those are hard bets to make. But right now, certainly the wind at their back, and they've come into significant per share earnings where in the past they had difficulty doing that. That looks like strong growth. The valuations, if we saw 20-25% growth, like some forecasts we've seen out there, I mean, this company wouldn't be that expensive despite the growth that we've seen there. So it is interesting. This spike going up 50%. That's why you see it up that much in the last month. There is strong potential going forward, but you certainly have to monitor end markets, monitor backlog on this business. So that's what I would
actually
do going forward.
like last week we had a client reach out to myself, and they were like, I'm sure you guys had written a report on 5N, Brennan.
Yeah.
You know, am I wrong? And I told him, I was like, no, you're right. You know, Ryan wrote up a report, a monitor report for our clients in July of 2023 in one of our electrification reports. And, you know, in that report, you know, it was basically like, this is a high quality business. You know, it's a little bit higher risk, but, you know, having a lot of potential over the next, you know, 2 to 5 years. We're, you know, 2 years from then, and, you know, the business has executed. And again, that's just something that I
certainly
want to
realize that potential for sure.
Yeah, exactly. And that's another thing that I want to like mention, like, and I'm sure I've mentioned it before, but just in a lot of these monitor reports, or a lot of these like comprehensive reports, that we do for clients, and we will include, you know, our top tier monitor list. A lot of those businesses do end up doing tremendously well. But yeah, you know, that's just one of them, you know, a good example of one of them.
Excellent. All right. Well, we can move on. Brett, I think, you were going to look at what company are you looking at? Oh,
another good example.
Cipher. Yes. I should know that. Jeez,
you should know this, because our clients should know this one as well.
All I've got on my mind is the Honest company for some reason, when honestly, I should have Cipher on the mind. Honestly.
You should have Cipher.
Honestly, yeah.
Yeah, so Cipher Pharmaceuticals, symbol CPH on the TSX. It's a company that, like I said, the client should be familiar with. Keystone recommended the company at $3.89 a share back in August 2023, just under 2 years ago now. But for those who don't know, Cipher Pharmaceuticals is a specialty pharmaceutical company with a portfolio of early to late stage products. Core products include Epuris and Absorica, which it respectively in Canada, the US, and Natroba, which they acquired last year, as well as the Parapro parent company, which is US-based. The stock is now trading at $15.07 share at $383 million market cap. So that is a 287% return since the recommendation just under 2 years ago now. A part of the initial investment thesis was really cash deployment, as the company was just a massive cash position at the time, roughly 52% of its market cap, as well as positive cash flow within it with its product portfolio, which is quite mature. We saw cash deployment come about a year later with the acquisition of US-based Parapro and its lice and scabies treatment, Natroba. The acquisition was well received, sending the stock as high as $19, up from the about $8 previous to that, $8.68. So over 100% increase in, it was about 2 weeks, but then it settled back down after that. Bit of euphoria there. But the acquisition was and still is a game changer for the company, but it does take time to see the actual financial benefits of the merger. And the benefits are now being shown throughout the last year, but specifically the last quarter has been quite good, to say the least. So moving into the recent jump in share price off the back of Q2 2025 earnings, these results are lapping the last quarter prior to the Natroba acquisition. So we can see a nice before and after acquisition, really comparison. Effectively a year after the acquisition, I will note that Q3 will not fully be comparable either, as Natroba was acquired in July, so you'd have still a month without Natroba being included. But continue on to Q2 results. Net revenue was up 152% to $13.4 million. Gross profit up 159% to $10.9 million at a margin of 81.3%. Adjusted EBITDA up 148% to $7.6 million at a margin of 56.7%, which is quite high. Diluted EPS up 83% to 22% a share. Overall, just a substantial increase across the board, but that is also largely due to the acquisition. But as you can see on the chart that I have below the financials there's sequential increases for both net revenue and adjusted EBITDA every single quarter since the acquisition. So Q3 2024, $10.4 million in net revenue, 4.1 EBITDA, which are already significantly higher, especially on that EBITDA line, going from 7.6 or at 7.6 from 4.1. And that's just a sequential improvement since the acquisition has been closed. While the company is now in a net debt position of $14.1 million compared to its prior net cash position, it likely won't be for that long, barring any future further cash deployments, which we do expect. But as you can see, there is quite a consistent trend towards that net cash position, again, barring no further layouts, like I was saying. The company has been actively just paying off its debt, ending Q2 with $25 million left in debt. But after the quarter, they actually further paid off a further $7 million. The company currently has a net debt at the end of the quarter, EBITDA of 0.9 times, which is completely manageable, not a concern in the slightest. And at this rate, barring any further net cash usage, it'll be 2 to 3 quarters before they'll be in a net cash position again. While the company did issue 1.5 million shares in part of the acquisition, causing the overall share count to increase year over year, the company has still been actually repurchasing the shares at the same time as repaying the debt. They have, for the first 6 months of the year, they repurchased 2.1 million or 230,000 shares. So overall, the balance sheet is still very strong given the cash flows, despite using cash for debt and shares to fund the acquisition last year. The company does have the ability to re-leverage itself if opportunities do become available, or they can just continue back into a net cash position if nothing is accretive, which leads us to growth prospects. The company still does have those organic or inorganic potentials with products or companies. Given its balance sheet, they can re-leverage up, like I said. But the organic side is also very interesting at this time. Natroba has the potential to displace the current licensed scabies treatment, permethrin, which holds about a 75% market share in the US, with Natroba at about the remaining quarter. Notably, in April, Illinois updated their preferred treatment for scabies and lice to Natroba from permethrin 5%, which is a really regulatory shift, because you do start to see as states, because they're all regulated on a state level for preferred treatments. Once one do it, another one will look at Illinois, for example, and that they can potentially shift. Whether or not that happens, we'll have to wait and see, but that is a good thing to see, is initial states making it the preferred treatment. The next growth opportunity is the company can carry out licensing of its current products internationally, specifically Natroba, for which management is currently looking for the right out-license partner. Then on the flip side, the company can actually look to in-license complementary products like dermatology, as it does have a way to market products within both the US with Parapro facility and Canada. Lastly, the company can bring its products across the border, specifically Natroba once again, into Canada, and try to do the same thing and overtake permethrin, which is over the counter in Canada compared to the US, where it's actually prescribed. Depending on the timing of any in-licensing or out-licensing or acquisitions, we could see further jumps in quarterly sales and profitability, but that depends on exactly how and what occurs and when. So quick valuations, the company is trading at a trailing PE of 23 times, and EV/EBITDA of 19.2 times, and a price to FFO of 20 times, which has went up since obviously our first recommendation, but it will significantly come down over the next year if they can continue to hit the same sort of results that we saw in this last quarter. Overall, we continue to like Cipher Pharmaceuticals despite the significant price increase. Since the recommendation, the company has obviously increased the valuation, but at the recommendation, it was quite a different company as far as financials go. It was a very cash-rich company awaiting deployment of that cash, needing proper execution, which does carry a lot of risk inherently to that. And obviously that was a success. So that risk goes away. You would expect a valuation increase to occur. And now it has both organic growth, which it previously just didn't have. It had up and down quarters, pretty much mature portfolio of products. They were cash flowing, which is great, and it was a very cheap company. But now we're seeing it move into that more growth stage where they can actually reinvest in themselves over and over again. And that's what we want to see in the future with further acquisitions or licensing opportunities. And the opportunities are really just supported by continued strong cash flows and really an improving balance sheet day to day. Clients will be receiving a full update in the near future. And just for disclosure, Keystone and Keystone employees currently do own the stock.
Yeah, it's a really good summary. I mean, what really excites me is that organic growth that you're starting to see, I think, from Natroba. And, you know, just generally speaking, the treatment versus permethrin, which is like kind of the incumbent, the treatment that's used the most in the US, for example. It's generally considered Natroba to be more effective, require less nit combing than permethrin, and there's some studies that have shown it to be nearly twice have twice the success rate, so significantly better than the existing product. And again, the fact that it doesn't require nit combing as part of the treatment. I know that Brennan is sick of combing nits out of my hair every time that I get lice, right? So I mean, we just know that alone is probably worth going to permethrin. Permethrin is going to Natroba over permethrin. Permethrin is over the counter. Natroba is prescription. But there's it looks like there's a tremendous growth avenue organically there for them in the U.S. We'll see. And it looks like it's going on that path right now. If that can continue, then like Brett said, with the cash flow there, the multiples that we saw should come down if the share price stays in the same range. And it is impressive to see going from that. They had significant cash, paid a good price for the business, but it's actually a reasonable price if it's growing at the rate that it looks like it is now. But go into debt and you're going to pay that off potentially in the next 3 quarters. Like that is going to net cash again. It's tremendous. And then they can, like he said, invest back in themselves again, invest back in the business, buy other, or, grow better organically with maybe a little more promotion. But it looks solid. We can move on to, honestly, I think it's got to be Brennan, isn't it?
Honestly, I think that's probably a good idea.
Honestly, you should just get into it.
Yeah. Okay. So the Honest Company, HNST on the NASDAQ, currently trading at a price of around $4 per share and a market cap of $416 million. So the Honest Company is a personal care company dedicated to creating clean and sustainably designed products. Its products include baby clothing, diapers, wipes, nursery products, skincare, and makeup. And as Ryan said at the beginning, the company was co-founded by actress Jessica Alba, and the stock IPO'd at $16 per share in 2021, raising over $400 million. So we have covered the stock a few times on the podcast now. The first time was back in November of 2024, following the company's solid Q3 2024 results, which led the stock higher. And this was when the stock was trading in the $7.30 range. And the second time that I covered the stock was just a couple of months ago in May of 2025, while the stock was trading around $5.40 per share. At that time, I reviewed the Q1 2025 results. Now I'm going to review the Q2 2025 results here. But, we have been getting quite a few questions on the business. And actually, right before its Q2 results, the stock had quite a volatile day, with one of our YouTube watchers stating, "What happened with Honest today? Rug pull," despite the stock being down just 3%. Now, I must say, if you're using the definition rug pull to describe a 3% decline in the price of a business that is producing revenue and profitability, you clearly do not know what you're talking about. As for those who do not know what a rug pull is, this is a type of scam in the cryptocurrency space where developers will abandon a project, taking investor funds with them, essentially causing the price of cryptocurrency to plummet and investors left behind holding the bag. So personally, I would not use Honest Corp and rug pull in the same sentence whatsoever. But anyways, like I said, the company did report its Q2 results last week on August 6th. So let's dig into the business to see how it is looking today and whether it looks like a steal of a deal like Andy, one of our other YouTube listeners, indicated. Potentially it does. So when we looked at the long-term financials in November of 2024, the business's revenue was growing with a compound annual growth rate of about 10% since 2019, but profitability was lacking. And although it was trending in the right direction, as you can kind of see down here below on the margins that I've got up on the screen. And the same thing could be said after I reviewed the Q1 2025 results in May. Revenue growth was good. The company had reported its 6th consecutive quarter of positive EBITDA and was getting into actual positive net income. Now, looking at Q2 of 2025, revenue growth was only 0.4%, so not that great, up to $93 million. And this was driven by an increase in retail revenue, but partially offset by a decline in Honest.com revenue, with management indicating that in Q2, shipments trailed consumption, partially offsetting the first quarter of 2025 results, where shipments were actually ahead of consumption by 5%. So are we seeing even, like maybe a little bit of a pull forward in Q1 because of their end customers trying to get ahead of potential tariffs, possibly. Gross margin increased by 210 basis points to 40.4%, driven by a change in inventory reserves, partially offset by tariff costs. I'll also note that as part to mitigate the impact of tariffs, the company increased inventory on hand during the first half of 2025, but there was a bit of a tariff impact in the second quarter, and it has come sooner than management has anticipated. They indicated that in the conference call. Adjusted EBITDA was positive 7.6 million compared to 7.6 million for the same period last year. And this represents the company's 7th consecutive quarter of positive adjusted EBITDA. And net income was a gain of about 3.9 million or 3 cents per share compared to a loss of 4.1 million or 4 cents per share for the same period last year. And this is the second consecutive quarter of positive net income, with the net income margin now up to 4%. So again, great to see that we are seeing, that trend of margins increasing. They're going in the right direction. But just generally, it does appear that the reason the stock, was down following the Q2 results were due to the slower or softer revenue growth and potentially, the earlier tariff impact that they are anticipating. Now, looking at the balance sheet, remains very healthy with cash of 72.1 million, no debt as it just has leases, and a net cash position of about 63.4 million or 57 cents per share. Now, management also reiterated its 2025 outlook following the Q2 results, guiding toward mid-single-digit revenue growth and adjusted EBITDA expected to be up about 10%. So again, we are seeing growth in revenue moderating to some degree from what it's grown at historically. And on a valuation basis, today the stock trades at about 12.4 times forward enterprise value to adjusted EBITDA, which in my opinion is starting to look much more reasonable than the other times that I covered the stock on the podcast. But cash flow is still lagging. So unfortunately, we cannot get a gauge on the valuation when it comes to cash flow. And on a forward price to earnings multiple, we're now looking at forward estimates with the business trading at about 34 times earnings. So still not necessarily cheap, but it is improving. And just generally, each time that I have covered the stock, margins have been improving. The share price is falling. So, it's understandable why the valuations are getting more appealing and more interesting here. Now, some other just comments that the CFO included on the conference call. He indicated we now expect roughly 8 million of gross tariff exposure in 2025. And for the second half revenue outlook, we will be lapping 2 large customer-specific promotional events with our 2 largest brick and mortar retailers that will not repeat this year. And he also indicated that Q3 revenue growth should be similar to that of Q2. So again, remember, it only grew at 0.4%. And Q3 EBITDA or adjusted EBITDA will likely be below Q3 of 2024. So again, although management has reiterated their guidance for the year, the profitability and revenue growth outlook for the second half of the year may be a bit weaker, actually. So to conclude here, the company has a great track record of producing high single-digit revenue growth, growing with a compound annual growth rate of 10% from 2019 to 2024. And the business has increased margins now with 7 consecutive quarters of positive adjusted EBITDA and 2 consecutive quarters of positive EPS, with that net income margin getting up to 4% or a little bit above 4% in the last quarter, which is great to see. The balance sheet remains healthy with net cash per share of 50 cents or 57 cents per share. Tariffs do remain a risk, and management indicates $8 million exposure for the year, but they reiterated their 2025 guidance, looking toward 4 to 6% revenue growth and 27 to 30 million in adjusted EBITDA. Nonetheless, management does expect Q3 revenue growth to be similar to Q2, which wasn't that great, and Q3 adjusted EBITDA to likely be down year over year. And lastly, the stock's valuation is at about 12.4 times forward adjusted EBITDA, but revenue growth is moderating in 2025. The business continues to get more appealing, but it currently faces some growth headwinds, which in my opinion could keep the stock kind of, bound to its current range in the near to midterm. If I was looking to, enter the stock or buy the stock, I'd probably be a little bit patient. It might be hard for, the stock to actually go up when they're looking at, some weaker results year over year generally. But, again, if someone was interested, I'd be, sitting in the weeds and probably just waiting for maybe, that forward EV to EBITDA multiple, maybe getting under 10 times. Maybe we can see that forward price to earnings multiple, maybe, get under 30 times. So again, it checks off a lot of boxes, but, still, I would be sitting on the sideline monitoring.
Yeah, I agree. I think that you want to see a little more revenue growth too, right? Like, if you're looking at a business like this, it's nice to see them move into profitability. We'd like to see that. I'd like to see more top line revenue growth over time. And that would, maybe the share price honestly drops another 50% and you get some revenue growth. And then honestly, we might look at it closer.
Even 12 times EV EBITDA is not a very cheap multiple. That implies to me you should be getting some growth out of that.
Yeah. It just isn't there at this point, honestly. All right. So let's look at Amazon. Aaron's going to give his take on the recent Q2 report from Amazon that was mixed, as I understand.
Okay, excellent. My pleasure. We will talk about Amazon.com. Symbol AMZN on the NASDAQ. It's trading at about $220 right now. And it's one of the biggest companies in the world, of course, over 2 trillion market cap. So Amazon is a company that does not need much of an introduction. Most people know Amazon.com and have used the website many, many times. What some people may not know about Amazon is that they actually are diversified into several different areas. One of those other areas that has been driving a lot of the growth in the business and the majority of the profitability has been their cloud computing business, which is AWS. So we're going to take a little bit of a look at that. The company recently put out their Q2 financial results. As Ryan said, they were a little bit mixed. Good on the headline numbers, but there were some concerns. Now, when we're looking at Amazon's performance over the past year here, it's performed well, up about 32% over the past 12 months, down slightly year to date. Now, the stock did pull back after the release of the Q2 results. It has since moved up just slightly, about 5%. Now, looking at the results, they essentially beat across all of the key metrics. So revenue up 13%, operating income up 35%, earnings per share up 26% to $1.68. They had an improvement in operating margin and a significant improvement in operating cash flow. So significant beats pretty much across the board here. And the company has now beaten its earnings per share estimates for 4 consecutive quarters. So looking at the company segment performance, when we break things apart, we have the online stores, which is the part of Amazon that most people are the most familiar with. And then there's AWS, $31 billion in revenue for the quarter. Now, AWS grew 18%. This is in isolation, a very strong growth rate. But this is really where the issue is, where the results become more mixed. AWS is the leader in the cloud market. They have about a 32% market share. But their market share has actually been very stagnant. So cloud is a high growth market. It's great that they have that leadership position, but they've been flat at basically 32% market share for the last several years. And this is while their lead competitors like Microsoft Azure or Google Cloud have been producing significantly higher growth and increasing their market shares. So just for comparison's sake, in the second quarter, Microsoft Azure grew its revenue by 39% and Google Cloud grew its revenue by 32%. So a significant outperformance there in terms of just cloud business versus cloud business. And those, again, are the two main competitors. And this is the most profitable segment of the company. So this is really where investors and analysts are concerned. Now, looking at the guidance, they are expecting strong performance in Q3, about 10 to 13% year-over-year growth, solid operating income. But really what I want to focus on here in terms of what management talks about with their outlook is where they're investing their money for growth. So they are increasing their AI investments, as many of the leading cloud and AI companies are, like Google, Microsoft, essentially all of them. Now, Amazon actually has the highest of all of the cloud budgets, about $118 billion planned for 2025, just ahead of Microsoft. The issue is that they're investing all of this money into cloud, but they haven't really demonstrated that they're able to achieve the same level of growth as some of these other key players. So I really think that this is what the market is going to be looking at for Amazon in terms of what's going to drive the share price potentially higher, is what type of return they can demonstrate off of these massive AI investments. Now, AI is clearly a tremendous growth market. All of the major tech players are investing heavily in it. All of them are producing growth. But the main concern here is that as the competition for that growth increases, the costs are going to increase as well. And ultimately, you're dealing with limited market sizes or markets that can only expand at a certain rate. So the concern is that these companies are going to see lower return on these investments. And in the case of Amazon, they haven't really demonstrated the same level of return, even to date, that some of the others have. In terms of valuation, based on the current share price of about $220, you're looking at 34 times trailing earnings and about 29 times forward earnings based on the midpoint of analyst consensus estimates for 2026. Now, I personally don't think that this is a bad valuation. It's more or less in line with what we're seeing for Microsoft. Certainly, it's a premium to the market, but not a premium to anything in terms of what we would consider to be a comparable technology company. That said, there are the concerns that we have. And those really come down to, can this company get back on a track of growing the market share of its cloud computing business? Or is it facing a situation where that market share may actually decline in spite of these massive capital investments? So this is something that we will look at. Overall, the fundamentals of the business are very strong. Strong fundamentals, good growth. The valuation is not unreasonable. I personally think that there are probably one or two better opportunities in the Mag 7 space than Amazon. But on the topic of valuation, it's a huge discount to where it has been in the past. That doesn't mean that previous valuation is a reasonable benchmark. I would rather compare it to what comparable companies are trading at today. But it's certainly cheap compared to where it has traded in the past. More or less reasonable for a long-term investor. So we'll continue to watch, but we're not buying right now. And in terms of disclosure, Keystone employees do own shares in Amazon.com.
Yeah, that makes sense. I think the cloud computing sector overall is growing around 22% last year, and they grew below that at 18%. And like you said, Microsoft at 39, Google at 32. They're lagging in terms of, yes, they're the biggest, but they're lagging in terms of just even the average growth in the sector. That's something that would be concerning to me. Okay, well, I think that'll close off our show for this week. We should have news out on a upcoming webinar series. Our upcoming summer 10X webinars should be out at the end of this month. We should have news on that shortly. Likely on the next podcast, we'll provide full details. All right, I'm going to close out the show. So if you're viewing this on YouTube right now, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.